Face it, retirement planning has changed, and the Secure Act 2.0 brings new opportunities, but also some new challenges. This video is for you if you want to make the most of these updates, avoid unnecessary taxes, and ensure your money works as hard for you as you did for it. Today, I'll break down the key changes, what they mean to you, and how you can take advantage of them. So, let's get started. While today's presentation does cover an awful lot, I'll leave notes for you down in the description. They're attached there, so you can refer to them as we move along or after you've watched the video. So, here's our challenge. The Secure Act 2.0, or Setting Every Community Up for Retirement Enhancement, bet you didn't know what that stood for, has passed, making it the most significant retirement legislation since the original Secure Act was approved back in 2019. There are roughly 100 provisions, primarily related to retirement plans. First, we need to understand, though, what the key changes are and how to assess their implication. The good news is that investors can enjoy numerous benefits, including more time to save, more ways to save, and more ways to use those funds that you've saved for retirement. The challenge is absorbing the change's breadth, depth, and timing. Most of these provisions became effective in 2024. Some became effective in 2025. However, others have been postponed until 2028. Today, we'll combine our findings under one big umbrella and highlight key changes you should be aware of. Today, we'll explore the highlights of the Secure Acts, Parts 1 and 2. The first part was passed back in December of 19. Version 2 was passed in December of 22. Their impact is far-reaching, ranging from the silent generation thinking about estate planning, to boomers and gender focused on retirement, to millennials and Gen Zers who could receive a sizable wealth transfer in the coming decade. As we all know, taxes are complicated and impact savings, investments, and retirement plans. Now, these new rules are generally very savings friendly. However, they require everyone to reevaluate their financial plans to capture the opportunities they present. In addition, the government sees businesses as a conduit to help expand and promote retirement savings by employees. I want to ensure you understand how the changes will impact you, your family, and your business if that's relevant. So now, let's press on. Keep in mind, everyone's tax situation is different, and you should consult with a qualified tax professional to discuss your specific situation. I'm a wealth manager. I do not provide tax advice. What I do is help people understand how the tax code and other rules could impact their financial planning and investments. And then I develop a retirement plan that considers taxes. Well, by now, you're probably thinking, what parts of the Secure Act will specifically impact me and my plans for retirement? And this brings us to our first key. The new provisions of the Secure Act give you more time to save for retirement. But you need to know how these provisions work to take full advantage of them. The Secure Act gives you more time to save for retirement and provides some great opportunities to save and reduce your taxes. So, what exactly does more time to save really mean? Several positive changes to age limits have been made. Some allow you to contribute longer to your plan, and others will enable you to delay mandatory withdrawals from your retirement account. Let's take a closer look. In the past, savers were forced to withdraw money from their IRAs starting at 70 and a half, whether they wanted to or not. These withdrawals are called required minimum distributions, or RMD. The Secure Act has now increased the age at which you start taking those forced distributions all the way up to age 75. Depending upon your current age. As you can see on our table, anyone currently subject to taking RMDs must continue to take their existing schedule. So, if you were born before 1951 and turned 72 in 2022, you should have taken your first RMD by April of 2023. And if you were born between 51 and 59, your required withdrawals start when you turn 73. It's worth noting that you can see a star on the table next to 1959. That's because we've confirmed a mistake in the law that would have those folks starting their RMDs at both age 73 and 75. Keep in mind, this will ultimately be rectified through a technical correction, but for our conversation, let's keep it at 73 for now. Now, those born in 1960 or later, they'll start taking their RMDs at age 75. All of this gives your money more time to grow tax-free. However, building up large R means larger future RMDs, which could have tax consequences when you draw down your retirement asset. That increase in income can have an effect on other social benefits that you might receive, such as Medicare. Now, in the past, failure to take a prescribed RMD resulted in a 50% penalty. That penalty has been reduced to 25% with a 3-year look back, and then further reduced to only 10% if the error is corrected promptly. Finally, the new law eliminates RMDs for Roth 401ks, 403bs, and 457b accounts, matching the rule for Roth IRAs. So, the question becomes more about the benefits of rolling the plan over to an IRA, investment options, fees, services, etc., which when you get right down to it is all pretty good news. Surviving spouses can now adopt their deceased younger spouse's RMD schedule. The primary benefit of the new rule would apply to older surviving spouses who can now assume a deferred RMD start time. The big benefit, if you don't need the money, they can delay withdrawals, allowing for potential growth in the account. Another benefit is that the RMDs would be smaller than if the surviving spouse treated the retirement account as their own. Remember, RMD percentages increase as you age. If the surviving spouse passes away before RMDs begin, the new 10-year RMD distribution rules do not apply, meaning the eligible designated beneficiary could stretch the payouts over their life expectancy. Previously, you could only contribute to your IRA until you turn 70 and a half, and then you would be forced to start withdrawing your RMDs from the account. This new legislation gives those wishing to work longer more opportunities to save and the potential to create a larger nest egg when they finally do retire. In 2024, catch-ups were adjusted for inflation. Also, this is important. If you make over $145,000 a year, depositing the catch-up into your Roth is mandatory. The employee cannot catch up if the employer does not offer a Roth. In 2025, a special enhanced contribution has been created for a very narrow bracket. For those 60 to 63, catch-ups are now $11,250 or 150% of the regular catch-up amount for a 401k or a 403b, and $5,250, again, 150% of the regular catch-up amounts for simple plans. This table frames the catch-up contribution changes by age. 49 or younger, the catch-up is not available. Standard catch-up for those 50 to 59 and 64 or older at $7,500 for 2025. The special treatment for those 60 to 63 or $11,250 for 2025. The bottom line is this. The new rule allows participants in IRAs, 401ks, 403bs, and simple plans to contribute more to their retirement plans each year. So, if you can keep setting more money aside each year, that's excellent. You'll defer taxes and grow more savings for your retirement years. You're probably thinking by now that these new rules make you think you should be putting more money aside for retirement. And that's a good thought because that's what the Secure Act rules help people do, including Roth plans at work, auto enrollment plans, and allowing for part-time workers and younger families and professionals to save more and access their money. Let's take a look. In addition to giving you more time to save, the Secure Act now provides more options for investing in retirement. Many of the slides coming up in the presentation will address changes to workplace retirement plan. Let's explore this important component and how it relates to your retirement funding effort. There have been quite a few changes related to Roth, both on the personal retirement IRA side as well as the employer-sponsored retirement plan side. The addition of employer contributions to the Roth side of the plan equation is a great opportunity to build assets that will escape taxation when withdrawals begin. Please note, it's not mandatory or automatic for employers to offer this. Offering you matching after-tax contributions to accompany Roth plans are entirely at their discretion. For those employees making more than $145,000 a year, your only option is to have the catch-up contributions placed in the Roth account. It's worth mentioning again that RMDs have been eliminated for Roth 401ks, 403bs, and 450 accounts. There is no need to roll a Roth 401k into a Roth IRA simply to avoid those RMDs, although there are a lot of other good reasons out there to do so. Now, starting this year in 2025, to encourage and increase retirement savings, your employer is required to auto-enroll you into their 401k or 401b plan. Then you'll have the chances to opt out if you'd like. In year one, they will determine how much of your salary they can allow you to put aside for savings. It'll be between 3% and 10%. Then, in years 2 and beyond, numbers will be increased between 3% and 15% annually. That number will auto-escalate by 1% annually. Those new to the workforce or changing jobs in 2025 will benefit the most. Studies have shown that auto-enrollment is increasing 401k balances. So Congress wants to continue the good work. But as we all know, the earlier you start savings, the greater the potential to create more money for when you retire. This also might be a good time to consider your 401k savings. And if you're saving enough, is it the right place to put your retirement savings? And how much will your employer match? Keep in mind that some business types are exempt from auto-enrollment requirements, and we can discuss this one-on-one to determine whether it affects you or not. Companies now have more freedom to offer annuities inside 401k plans. So why is this important to you? Well, because one of the most complex parts of retirement income is making your total savings last the rest of your life. Annuities are an insurance product designed to turn a portion of your savings into a lifetime stream of income. And they can be an interesting solution to the question, as I get older, will I run out of money? This new legislation casts a wide net and provides small businesses yet another way to attract, retain, and help their employees save for retirement. The starter 401k is a great place to start, though it may not be as attractive as a traditional plan because employers are not required to match your contributions, and contribution limits tend to be a little bit. However, it is a step in the right direction to help boost overall retirement savings rates. There's also some good news for part-time workers who want to save for retirement. Employers with a 401k plan must allow employees to contribute to the plan once they've worked at least 5 hours for the last 3 consecutive years, or 1,000 hours throughout the year. This is especially good for people who do work part-time because they're given less opportunities to save for retirement. Just a quick heads up though, if you are a part-time employee, check when your 500 hours start and end with your employer. Their dates may not be as precise as a calendar year. Beginning in 2020, the Secure Act added 2 options for Roth contributions to simple and SEP plans. Although your employer is not required to implement these plans, if they are available, you may want to take advantage of them. You can also offer your household employees a SEP IRA plan. Depending upon your financial circumstances, this could be a nice benefit. The Simple and SEP plans for Roth provide a simplified way for small businesses with 50 or fewer employees to contribute to employee savings, and to yours if you happen to own the business too. Prior to 2024, Simple and SEP plans only allowed for pre-tax funds, which are taxed when they are withdrawn. Additional employer contributions are now allowed for Simple IRA plans. These will be capped at $5,000 per employee in addition to the required matching or 2% pay of a non-elective contribution. Once again, there may still be good reasons to roll that Simple or SEP assets to a Roth IRA, and you need to take a look at availability. Investment options, fees, and services are all something you should consider. These rules are especially beneficial for new families and young professionals. While highly compensated individuals are ineligible, money must be held in cash or equivalents, and participants must have monthly access to these funds. Since many Americans don't have rainy day funds, the emergency savings account can provide a way to set aside some money every year for unexpected expenses. And you can do it through your retirement plan. While it only offers $1,000 annually, the definition of an emergency withdrawal is broad and accounts for many circumstances. There is a new student loan repayment match where employers can help employees pay off student loans. An employer can make a matching contribution on behalf of the employee into a 401k, 403b, 457B, or Simple IRA for qualified student loan repayments. This feature became available to employers in 2024. In addition, graduate and postdoctoral students can start contributing to an IRA with the expanded definition of earned income. Graduate and postdoc students' stipends and non-tuition fellowship payments count as earned income, which means they can contribute to an IRA now. This is good news for students who want to accumulate tax-favored retirement savings, because in many cases, graduate study keeps them too busy for a job that might offer a 401k or other employer-sponsored plan. There are new disclosures on your 401k statements that show you how your total savings translate into monthly income. This information can help us discuss your retirement, especially for future cash flow and income needs. You may be saying to yourself, I see how I'll have more time to save now. Can the new rules help me in other ways? The short answer to that is yes. The new legislation has made sweeping changes to how you can use your money, from 529 conversions to funding long-term care. Let's explore a few of the more prominent changes you need to know about or have broad applications for investors. We all want to feel confident and responsible about handling our money. I'll share some parts of the Secure Act that will give you new ways to use your savings. You'll have a new option for making charitable donations more tax efficient. You can also maximize college savings accounts, or 529s, in new and interesting ways. And finally, some new reasons exist for withdrawing money from your retirement account without paying the early withdrawal penalty. I'm sure many of you are familiar with qualified charitable distributions, or QCDs. If you're not, QCDs were introduced in 2006 to help people aged 70 and a half satisfy their required minimum distributions, their RMDs, by making a charitable gift from their IRA accounts. Keep in mind specific rules that need to be met, and they can directly transfer up to $100,000 from their IRA to a qualified charity of their choice. Again, that donation would satisfy the RMD requirements for that year. Effective last year, the new law maintains the maximum transfer of $100,000, but that will be adjusted for inflation each year. For 2025, the QCD limit is $108,000. It's important to note that it must be a qualified charitable donation. It's best to check with your tax advisor because some organizations, such as a private foundation, are ineligible for donations under this law. The new QCD law allows for a one-time only ability to fund up to $50,000 in split interest entities. This can get a little bit technical, so if anyone wants to discuss it one-on-one, I'm happy to have a follow-up conversation with you. This rule change allows you to use money initially set aside for your kids' or grandkids' education. No need to dip into savings earmarked for your retirement. Investors in the 529 educational savings plans can now withdraw up to $10,000 to repay loans. We all know that student loan debt is a crisis in America. This new provision is one way that savers may find some relief because it allows them to put less money towards student debt and more towards retirement savings. Related changes, the 529 plan monies can also be used for apprenticeship programs, provided they are registered with the Department of Labor. Since some kids don't attend college but still need money to prepare themselves for the workforce, now they can use the 529 plans their families may have already funded. In case you didn't know or possibly had forgotten, a $10,000 per year withdrawal to cover private K-12 education broadened the use of 529 plans back in 2017. Do you have or anticipate having money left over in your child's 529 plan? Well, this new rule could make saving for your child's college easier and jumpstart their retirement savings. Here are some of the details. Excess funds in a 529 plan can be rolled over directly into a Roth IRA for your child, assuming they're the beneficiary. The beneficiary must have earned income. As with other rollovers, you are not taxed on the funds transferred and the money continues to enjoy tax deferral until withdrawn. Beginning in 2024, you can roll over up to $35,000 total for a lifetime from the 529 plan to your child's Roth IRA. These annual transfers are also subject to the annual Roth IRA contribution limits, currently at $7,000. Another benefit to this rule is that participants have no income limits. At the same time, high wage earners, $146,000 or $230,000 joint, usually make too much to contribute to it. They will now be eligible to do so for their kids or grandkids with 529 bucks. Now, as with all things, there are some strings attached. First, the 529 plan must be in place for 15 years before it's eligible for a rollover to a Roth. Money added during the past 5 years cannot be used. If you max out the 529 transfer for the year, $7,000 in this year, the beneficiary, the child or grandchild, can't add funds from their own sources. You're capped at the annual limit for Roth IRAs. The bottom line is this. Now we have some flexibility when we have excess funds in a 529 plan. You can keep all the funds in the 520 without penalty, and your child can use the money for their education, or you can transfer the funds to jumpstart your child's retirement. The best solution to this is unique to your situation. Several new items have been added to the penalty-free withdrawals you can make from your qualified retirement accounts before 59 and a half. One of them is paying for long-term care insurance. This is a tremendous benefit for several reasons. As we age, more and more of us will encounter a significant health event that requires long-term care, such as an in-home medical assistance or a nursing facility. The high cost of care for an unplanned critical illness or health crisis can be catastrophic for families, and unfortunately, Medicare doesn't cover much. A private room in a nursing facility can cost upwards of $100,000 depending upon where you live. And as we know, many people forego long-term care insurance because they think it's too expensive. But if you're surprised, the cost of care is also high. This new rule makes it more affordable and tax-friendly. Now, clarity is needed from the IRS about the type of long-term care that qualifies under this rule. The law is somewhat vague and only calls for high-quality LTC or long-term. If you have health issues or a family health history that concerns you about your future, let's schedule a one-on-one to discuss how to take care of that. At that time, we can explore your unique circumstances and see if long-term care actually makes sense. This update is from the original 2019 Secure Act, but it's worth repeating. Penalty-free IRA withdrawals up to $5,000 per parent, if both have a qualified plan, is allowed within the year of the birth or adoption of it. What we mean by that is it's not retroactive to the child being born before the 2019 Act. Twins or triplets, the cost is $5,000 per child per qualified parent, and we can discuss the numbers if you're interested. To meet the requirements, the individual must take a distribution from the retirement account within 1 year of the date of birth or the date on which the adoption of an individual under 18 was finalized. Although there's no penalty, you still may owe taxes on the money withdrawn as ordinary income, unless a Roth or after-tax contributions were withdrawn. Distributions can be paid back into the plan anytime without a time limit, but consult your tax advisor on how to report this on your tax return and whether previously paid taxes can be recouped. Of course, these withdrawals do mean less savings for retirement. So, based on your overall financial plan, talk with your financial advisor to determine whether withdrawing this money is a good move or not. Several new provisions have been made allowing for special circumstances. Early withdrawals will be qualified as penalty-free for someone who is terminally ill or victims of domestic abuse, and for public safety workers, which now includes firefighters and others. A provision has also been made for expenses resulting from a federally declared natural disaster. The rule is retroactive to disasters occurring in 2021 or later, allowing for a maximum distribution of $22,000, which may be taken and repaid over a 3-year period. Retirement plan loans for people in those disaster areas are increased from $50,000 to $100,000. Undoubtedly, there are some of you who have already accomplished saving enough for retirement. Kudos to you. And now you're starting to think about the next generation and estate planning and wondering, what do we need to do about leaving our IRAs to our kids? Is that still allowed under the new rules? Unfortunately, the news here isn't real good. Our fourth key point is that your kids can still inherit your IRA, but they can only defer taxes on it for up to 10 years. This was a big rule change in 2019, and it's worth addressing today. Not only are your retirement savings affected by this new rule, but the death of the stretch IRA requires you to review your estate plan as well. Let's look at this a little more closely. With certain exceptions, which we'll see shortly, IRA beneficiaries, including Roth IRAs, must liquidate their accounts within a 10-year period. Previously, IRA owners were encouraged to have younger beneficiaries because they could stretch the distributions over their lifetimes, allowing for longer tax-free growth. Some heirs even plan to use the accounts for their own retirement. But now, they must withdraw the money within 10 years of the original owner's death. This could have significant repercussions for the beneficiary. When they withdraw that money, they must report it as income and pay tax on it. So, if you have a child applying for college aid, it could also affect the FAFSA and the student loan application forms, and the possibility that it will limit their ability for certain tax credits. There is no rule about how to draw down the account, provided that it's gone within 10 years. So, a beneficiary could take some out each year over a 10-year period, or none for 9 years and everything out in that 10th year. Clarification of this rule regarding whether the original owner had begun taking RMDs and how that should be handled has been published. And if you're in that situation, I'll be happy to discuss that with you later. Planning is needed, and this should include consulting with your accountant. If you have a large IRA balance and know it's going to be a part of your estate, let's sit down and talk about the effects of that on your estate planning. As I said, the 10-year rule, or what the IRS calls eligible designated beneficiary, has exceptions. They include surviving spouses, disabled or chronically ill beneficiary, and those who are not more than 10 years younger than the original owner, and minor children. In that last case, the 10-year clock starts when the child reaches legal adulthood and doesn't include grandchildren or other relatives of the original IRA owner. For all of these eligible designated beneficiaries, the stretch IRA is mostly business as usual. The new rule also does not apply to people who have already inherited an IRA, only those who inherited it 2020 or later. The real lesson from all the changes, particularly the death of the stretch IRA, is that tax planning is more critical than ever. Congress is looking for ways to increase revenue, and one way to do that is to eliminate tax breaks. We may see other changes before you retire or pass on your estate. For years, people were told to rely on IRAs for decades, and many Americans listened, and they were helped by a 10-year plus bull market. They now have a lot of money invested in these tax-deferred accounts. The problem is that one day that tax bill is going to come due, and you can't predict what the tax law will be like when it does. As I've said, I'm not a tax professional, and I don't give tax advice. Your accountant should review all of your tax decisions. But I can look over your investments and savings and help you plan for this. Taxes and retirement are a much bigger issue than many people realize. I can help you develop a retirement plan so you can draw down your accounts in a tax-smart way. Some of our strategies might include Roth conversion, managing your tax brackets, reviewing your beneficiaries, including trusts, and creating estate plans that makes the best sense for everyone in your life. Well, hopefully I've conveyed the importance of the new retirement rules brought about by the Secure Acts. You can see how important it is to focus on what will have the most significant impact on your life. And you're probably wondering what the next steps are. First, let's review the key points we've covered. We started our presentation by saying that the Secure Act changes the retirement rules, and that current and future retirement plans must be reviewed and adjusted. Our first key point, the new provisions of the Secure Act, gave you more time and ways to save for retirement, but you need to know how these provisions work to take advantage of. Our second key point, the Secure Act gives you more ways to save for retirement. Our third point, the Secure Act provides smart and responsible new ways to use your money. Fourth and final key point is that the death of the stretch IRA means your kids can still inherit your IRA, but they can only defer taxes for up to 10 years. Understanding these new retirement rules is just the first step. Now it's time to apply them to your situation. I invite you to schedule a one-on-one complimentary meeting where we can go over the specifics of your situation with a detailed checklist to ensure that you're maximizing these opportunities. Feel free to click the link in the description to set an appointment. If you found this video helpful, Don't forget to like and subscribe and leave a comment with any questions. And I look forward to hearing from you.